the advice from that great philosopher, Donald J. Trump, that it's not a crime to avoid taxes. That's avoid, not evade. Avoiding is good. That's what the tax laws are there for, to help you avoid taxes. And evading is not good. Anyway, with that, turn it back to you, Alain, and open it up to questions.
Thank you, Michael. That was a very interesting presentation, as always. And I especially like to thank you for the shout out to accountants. It's a little bit of a joke because I'm an accountant. We have a number of questions already, so I'll read them and let you answer them, Michael. Keeping in mind that, again, Michael is not providing advice, but information, as he's stated in his disclaimer. The first question is, what does ETF stand for and where can we buy them? I think you've partially addressed that, but maybe you could just quickly remind everyone.
Sure. ETF stands for Exchange Traded Fund. And what an ETF is, it's a type of mutual fund, but it is bought and sold like a stock. And the advantage of ETFs is primarily lower cost. So typically, if you buy a mutual fund, you buy it through an advisor or a bank or something like that. Those mutual funds contain what are called trailing commissions. And those trailing commissions can be 1% or more. So a typical Canadian mutual fund has a total MER, management expense ratio, over 2%. ETFs do not pay trailing commissions because you buy them directly as like a stock. They are also much cheaper to administer than a mutual fund. So where a typical actively managed mutual fund, as I say, has a management expense ratio over 2%, a managed ETF that I've shown you here has a management expense ratio of around 0.6 of 1%. So about 1/3 the cost. How do you buy them? You have to have a brokerage account, either through a traditional broker or an online brokerage account, such as through any of the major banks or Questrade or one of these folks. And then it's actually very easy to buy them. And if you go into a number of banks, I've found RBC to be very helpful. You can even set up a meeting with one of their financial advisors. They'll show you how to set up an online account. It's really quite easy. And they'll even show you how to buy and sell things on it. And RBC even has a practice account within their site once you set it up that you can practice buying and selling these things. A lot of people get very nervous about it, I know, but it's really quite simple to do. And it's a great way to save a lot of money.
All right, thank you, Michael. And just to remind everyone, if you have questions, the chat box is open, so you can type your questions in the chat box and we will answer them or attempt to answer them anyway. The next question is, if you decide to recall your preferred shares before its maturity, what are the consequences?
Well, if you don't recall them, you simply sell them. If you're the individual buyer, you just sell them on the open market the same way that you would buy and sell a stock. So the only consequence may be that you're selling them at a lower price than you bought them at, or if you sell them at a higher price, that you have to pay some capital gains tax on the capital gains. But the recall or redemption provision is strictly given to the issuer, not the buyer. But as I say, these things are freely bought and sold.
The next question, I think, relates to what you just said. When preferred shares are sold, not recalled, but sold, at what price are they bought back? So that's, again, that would be at the market price.
Yes, if they're sold, it's at whatever is the market price. If they're recalled or redeemed, then there are fixed amounts that the issuer has to pay. So, for example, the typical issue price on preferred shares is $25. That seems to be the standard. Typically, an issuer will say, if I'm going to redeem this after 5 years, I will redeem them they cannot redeem them below the issue price. So the issue price, $25, that's the minimum. There also often are provisions to say if I redeem it early, I will pay more than the issue price. So $25.50, $26, $26.50, depending on how soon after they are issued, they're redeemed. These things are in there to protect the purchaser. But if the bottom line is if it's redeemed, the minimum that you can get back is the issue price, typically $25, sometimes more. If you sell it on the open market, you get whatever the open market is paying at that time.
Just to make sure that everybody understands, when you talk about redeem, that's at the option of the issuer of the preferred shares.
Correct. Only
at their option. That's correct.
And that option is built into virtually every single preferred share.
Yes. The next question is, would this be a good investment in a TFSA, which is essentially a no tax account?
Well, in the TFSA, of course, you don't get the tax benefit because there's no taxes on a TFSA, and you don't file, your TFSA income on your income tax. But if you want to have a nice, assured stream of income that you can pull out on a regular basis as income that you don't have to pay any tax on, it's one way of getting, say, 5.5% income, which when you consider what a GIC is paying today, which is what I think the maximum I've seen for a GIC is about 1.6% today.
Yeah.
So 1.6 versus 5.5. Now, more risk with the preferred shares because it can value where the ETF is not. A second here. Can you hear me okay, Alain?
Yes, I can hear you.
Okay, good. I'm just seeing I'm getting notices up here that I'm being muted. So, Alain, you might want to just explain to people how to use the text box or the control H.
Yes, if you want to write a question, on your screen, you should see a bubble that says chat. So you click on that if you're sitting at your computer with a mouse, and you write your question in the space where you can write question. If you're using an iPad or some other device, such as myself, I'm using an iPad, you'll see 3 dots at the top right hand of the screen in my case. And that's where you would click to be able to write your question. So you click on those 3 dots, you see something that says chat, and then that opens the chat box for you. That's basically it. Another way to access it is through the control H, as Michael mentioned, on your keyboard, and that should open the chat box as well, and then you can write your questions in there. Okay, so we have another question. Let me see here. I have to get back to where we were. Oh yeah, something that you mentioned earlier, but needs some clarification. RIF or RIF withdrawals are taxed at income rate or interest rates.
Well, yeah. Well, the interest income is taxed at the highest income rate, right? Basically, there's 3 tax rates that you get. There's regular income, which includes interest, rent, that sort of thing. There's dividend income, and there's capital gains. Each one is taxed at a different rate. And typically, interest income, which is equal to regular income, is taxed at the highest marginal rate. All RIF withdrawals, no matter how the money was generated within the RIF, are taxed at the highest marginal rate, which is equal to the rate on interest. Correct, Alain?
That's correct. Your regular income, your interest rates or income that you earn on interest-bearing accounts, for example, at the financial institutions will bear the highest rate of taxes, which is basically the same as your marginal rate of tax on your regular income. And then dividends with the gross up, there's a calculation, so you end up paying less in taxes after you've done the calculation. And capital gains is only taxed at 50%, but then there may be additional calculations to do if you had capital losses in previous years, and depending on how far back those capital losses go back. So it can be a little bit complicated if you're not used to doing those types of calculations, and it's a good idea, if that's the case, to seek the advice of a trained professional. Not your neighbor or your cousin that has read an article somewhere, but someone who's really up to date on what are the tax laws and the tax rules.
Alain, speaking of that, just while we're on this, what are the rumors about changing the capital gains inclusion rate?
Well, I'm not in the secret des dieux, as we say, but I've read, just like everyone else, that may be one of the things that the finance department will look at in the future. There's no firm decision or information, and certainly I haven't seen anything in the latest speech from the throne about that.
It is interesting, though, thinking about it, and again, I'm not predicting anything, but I would think that the dividend tax credit, that in fact that so many retirees who don't have pensions rely on that for income, I think might be a little more sacrosanct than the capital gains inclusion rate, which is seen as more going to the fat cats.
Yeah, and capital gains inclusion rate have changed over the years, as I said earlier. Depending on how far back you go, if you have capital losses, the inclusion rates are different. So you have to calculate them based on basically when the capital losses have happened. So you're quite right, Michael. This is one of the things that it's easier for a government to change through the tax laws. Going from right now, the inclusion rate is 50%. It's easier for a government to change it to a lower amount, a lower number than it would be to make some other tax changes. Right. And the political impact of that would be certainly less severe. Right.
I just raise it as another argument in favor of dividend income and preferred shares.
Yes. Yeah, it would be more difficult and certainly more complicated as far as changing the tax rules and the tax laws to change the gross up and the dividend income, the way that dividend income is taxed. Yeah. Our next question is, what is par value with respect to preferred share issue?
Well, I think I mentioned that, but typically preferred shares are issued at par value of $25.
Yeah, they're in increments of $25. So whatever amount you want to invest, you divide by 25, and that basically tells you how many preferred shares you would get.
Yeah.
Is it normal to hold the preferred shares in RRSPs, TFSAs, or only in retirement in RIFs, or not registered account? So basically, you have RRSPs that will be taxed at some point in time when they're converted and withdrawn or withdrawn. TFSAs that are not taxed, and non-registered accounts that are taxed.
Yeah. Well, and the answer to that is all of the above. You know, if you need the income generation in your RIF, let's say you're around 71, 72, I think the minimum RIF withdrawal rate, try saying that fast, is around 5.2%. So if you can generate 5.5% from a preferred ETF, you can cover some of that mandatory minimum withdrawal. Similarly, if you have money in a taxable account and you want income to spend, I mean, I used to have very expensive travel habits, don't anymore, clearly. but at least not for a while. But it was nice to have that income being generated in my taxable account where I was getting the equivalent of 7% interest, which, as I mentioned, is impossible to find anywhere except buying bonds from some pretty sketchy companies. And in a TFSA, it's also great because there you've got 5.5% income typically coming in and you pay no tax on it. So I think depending on the individual situation, you can find a use for preferred shares in all of these accounts.
Yeah, that points out the fact that it's necessary to have an asset allocation strategy. And I think that you're going to talk about that in a future seminar. But
yes,
really,
exactly.
really, there's not one answer to a question such as this one. It depends on your needs and your preferences.
And that's a good time to mention, Alain, that in terms of, what percentage should risks be of an overall asset base, again, it depends on the individual, but, certainly 5 to 10% is not outlandish. And in some cases may even, be justified to be more than that.
Okay, our next question is, that's quite a lengthy one, so I'll read it. My portfolio is 70% reset preferred shares bought in 2012, 2014. Many are worth about 50 to 60% of the original cost. Would have liked to sell, but the losses are significant, so I have no choice but to hold and hope that they will appreciate over time. Do I have any other alternative strategy with these losers?
Yeah, well, that's a tough question. The thing is that the value has gone down because they're going to reset at a much lower interest rate. Typically, when these things were issued, they were paying probably a Bank of Canada 5-year, which at the time was probably around 2.5%, 3%, plus an additional 3 to 4% on top of that. The 3 to 4% on top stays, but with the Bank of Canada rate down to 0.35, obviously the payout is going to drop dramatically. And that's why the value of these things has declined. The rate resets are unlikely to be recalled because they're going to reset at a lower rate and save money for the issuer. So they're not likely to be recalled. So really your only option is to hang on, hold your nose, and wait for sometime in the future when the interest rates climb again. I don't know when that's going to be. It could be a long time. According to the Bank of Canada, it's going to be a long time. But, I think most of us might think that interest rates are not going to stay near zero forever. So if you've got a long-term horizon and you've got these things now, you might be better off, as I say, to hold your nose and collect your dividend and wait.
Yeah, and again, this is a complex question. There's no one answer. So that's where it's useful to consult with a trained professional, trained tax professional. Because there's not one right answer. It really depends on a number of factors, and you have to crunch the numbers.
Yeah, and in this case, also talking to a trained investment advisor with an E who understands preferred shares, and unfortunately, my experience has been the vast majority of them do not understand preferred shares.
Unfortunately, you're right. The next question is the Globe and Mail article you referenced mentioned that a new product called Limited Resources Capital Notes will replace preferred shares. Can you comment on this?
Only vaguely. I have to admit, I don't completely understand it. Those notes are only available to banks and financial companies, as I understand. And Let me back up a bit. The question is, why do companies issue preferred shares at all? Why would they pay twice as much as their bonds do? Well, the simple answer is that preferred shares count as equity, the same as common stocks do. And companies have to keep a certain ratio of debt to equity. And particularly the financial institutions do. And it's mandated by government. So they've developed this new instrument, and I can't even remember the name of it, LRNC or something like that.
Yeah, limited resources capital notes, yeah.
Yeah, I think it's limited recourse capital.
Or recourse, you're correct, recourse.
And the limited recourse means that, and I don't pretend to fully understand it, but basically means that these things are similar to equity, because whoever buys them has limited recourse against the issuing company, but they're paid as interest, not dividends. And so banks and other financial companies like insurance companies will choose to use this as a way to raise equivalent to equity at a lower cost. And that's another reason why the number of preferred shares out there are going to decline, because the banks have stopped issuing them.
Yeah, and that's basically the conclusion that I came to as well when I read the articles, that they're issued because it is an advantage to the issuer, whether it's a bank or another institution, but they're an advantage to them to provide them with additional capital to basically be able to redeem preferred shares in most cases.
Yeah.
The next question is the minimum price on a recall lower than what you paid? And here recall, I think of the person who asked the question may mean redeem, or could mean when you're selling the shares on the market. So when would the minimum price be lower than what you paid?
Well, if you paid more than par value for the shares. So for example, if the par value is 25, and you bought the shares at a premium of 26, and they are redeemed, you would only get 25. Mm-hmm. So one of the things that they use when they calculate yields on these things, and you can, with a little research, find it, they usually have a calculation called yield to redemption, which gives you the effective yield if you have to have your shares redeemed for a different price than you bought them at. So if you buy them at a premium, the yield to redemption will be less than the face yield. But if you buy them at a discount, the yield to redemption will be more than the face yield, if you follow me.
Yeah, and you would buy them at a premium or at a discount on the open market.
Correct.
When they're issued by the issuer, initially they have a par value, which is normally $25.
Correct.
Yeah. Okay, next question. What percent of preferred shares would be normal in your portfolio, or is it very income dependent due to the clawback?
Yeah, that's a good question, and it depends on the individual, obviously. With the clawback, I'm not as worried about that, because if your income is exceeding $79,000, you're going to get clawed back regardless of how you earn that income. But preferred shares, you do have to be careful because of the dividend markup that adds, believe it or not, 38% to the amount of the dividend when they calculate your taxable income. Very complicated. As Alain says, good place to get professional advice.
Get professional advice, yes.
But in terms of how much, a lot of it depends on your view of the world. I mean, what do you think stocks are going to do over the next while? How much income do you need? What do you need it for? I have to say that when I look at what's going on in the world, I have a very hard time being terribly optimistic. And so the idea of having a stream of income that is pretty much solid for the next while is something that I find appealing. How much, it's up to each individual's needs.
Yeah, wants and needs. That reminds me of something I thought when I was teaching at the university in one of the marketing courses. Be that as it may, here's a question. Someone's asking, how do you select a qualified financial advisor? And Michael, you'll have a seminar on that coming up shortly.
Yeah, I think that is a question that's worth its own webinar, is it not?
Yes.
But the short answer is find somebody who is an advisor with an E, not an O, and find somebody who has a certified financial planner designation, CFP, because they, by their own association rules, have to act in your best interest, which is not the case of the ones that you find at your friendly bank branch. There are some online sites that list fee-based financial advisors, which I think is the way to go. I don't have them in front of me right now, but if you Google fee-based financial advisors Canada, I think you should be able to find a list of them in this area.
Okay. Next question is, would there be a difference if someone is not yet 71 vis-a-vis RIFs and investing choices? I think the 71 there is the cutoff for converting RRSPs to RIF.
Yeah. The answer is, it depends, I guess, how close you are to 71. But if you're within a few years of it, getting your financial house in order so that you're able to meet those minimum RIF withdrawal requirements is not a bad idea. And right now, these preferred shares, as you've seen, are paying a considerable premium compared to bonds or GICs and things like that. So, and if this manager of the HPR ETF is correct, then prices do begin to go up because the amount of preferred shares out there are going down. It might be wise to start, getting used to these things now rather than waiting until you're 71. But again, those are personal decisions. I can tell you that I personally just turned 71, and I've been investing in preferred shares for a number of years. And my dad, who was a very successful business person, used to say he loved preferred shares because once he bought them, he never sold them. He just kept them, and they were basically his retirement account.
I must say, Michael, you're a very young 71, so your life expectancy is quite a few years ahead of you yet, and you probably have a different investment horizon than someone who's in a different category. But be that as it may.
It's all the wine I consume.
Yes. Our next question is, once you invest in a specific preferred share, for example, ZPR, like a stock, do you have voting privilege on that preferred share? And that's something that I think is easy to answer, but I'll let you address it.
Yeah. Well, first of all, ZPR is not a specific preferred share. It's an ETF, so it's a fund. So if you have a fund, no, you don't have any voting rights. No, preferred shares do not give you voting rights. Only common stock gives you voting rights.
That's right. Next question is, again, we're coming back to the issue of recalled and redeemed. To clarify that, recall is not a term that is used when you're talking about issuers. They redeem their shares or you sell them on the market. That's basically the difference, correct, Michael?
Yeah, that's correct. I mean, sometimes it's called recalled, redeemed. They tend to be used means the same thing, that the issuer is going to take them back and pay you out, right? And you don't have a choice
Yeah.
because it's part of the terms of the initial offering. So yeah, it's
So
all redeem,
yeah.
same thing.
So the issuer will redeem or recall, if you want to call it that, the shares. And you as a holder, you can sell them on the open market, much like normal stocks are sold. There's a market for preferred shares. Yeah.
Yeah, you can buy and sell preferred shares any day that the stock markets are open.
Yeah.
One of the issues I should mention is that because of the lack of liquidity, you often can find that there's a very large bid-ask spread. So in other words, how much people want for the preferred share compared to how much people are willing to pay can be quite wide at times. And it can be up to almost 1%. And so often, if you're buying them individually, it can be very frustrating because you have to kind of set your amount that you're going to pay, put in what's called a limit order, and then it's a bit like ice fishing. You sit there dangling it, and it can take sometimes days for your order to get filled at the price you want, and sometimes never. So really, for the vast majority of people, I think that they're much better off using one of these ETFs and not trying to buy it themselves.
Yes. The next question sounds like the person is asking for advice. So again, I want to remind everyone that we're not providing advice, we're providing information. And you should make your own decision based on having conducted your due diligence. But the question is, to address the world uncertainty, risk versus return, with your preferred shareholdings, you mentioned HPR, ENB, which would you consider the best for a more conservative choice?
Well, I can partly answer that. HPR, again, is a fund, where ENB is a specific company. And to repeat, I think that 99% of us should not be buying specific shares. And that holds true even of regular common shares. I just don't think we have the information and the knowledge. So I think most people should buy a fund, and something like HPR or RPF or ZPR, one of these preferred share funds, and let professionals do the picking for you.
Yeah. Struggling companies will cut dividend on regular shares before preferred shares. Would you recommend these in a portfolio for young adults?
Probably not. The preferred shares are for people who want income. And young adults probably should be investing for the long term, which is capital gain. Also, preferred shares generate tax because every year that the dividend is paid, you have to include it in your taxes. Where capital gain, you don't have to declare anything until you sell the underlying securities. So my short answer is no.
Okay. Like regular dividends, are preferred share dividends paid on a quarterly basis?
Typically, yes.
Okay. And that's the end of our question. So thank you very much, everyone. Just to remind you that the seminar, the